Well, hey everyone, this is chapter 20, and we're going to start off with example 20-3. And so what we're doing on this one is we're going to talk about variable costing, and so as compared to absorption costing. So what we've been doing this whole time, what you guys always did in financial accounting, which is your normal GAAP way of putting together an income statement, was absorption costing. So that's what we've been doing this whole time. And so what we're going to do is we're going to switch gears and do variable costing. And so now if we're producing financial statements to outside parties, we still have to do absorption costing. But for internal purposes, we have the option of doing variable. And so essentially what the difference is where in absorption costing, when we're calculating cost of goods sold, we add in our direct materials, our direct labor, and then our factory overhead. And that factory overhead is both fixed and variable. And so that's a great way to do things when you're trying to figure out your true product cost. Because when you want to figure out, hey, when I sell a good, what's all of the cost that are related to that? And so that's what absorption costing and regular accounting is built for. However, internally we might have different questions we want to answer. For example, we might be more concerned about cash flows or how much we're going to spend by producing so many units, and that's where variable costing comes in. And so essentially what the difference is variable costing, when we're figuring out it's not necessarily called cost of goods sold, it's more of a cost of goods manufacturing, is we're going to take our direct materials, our direct labor, and just the variable factory overhead. And we're going to separate out those fixed overhead costs and fixed manufacturing cost. And instead of putting them into inventory and then expensing them when we sell the goods, we're going to treat them more like a period cost and expense them as soon as they're spent. So let's go ahead and jump in and start doing 20-3. So in this one, we have Bionic Cotton. They're manufacturing high-end sporting goods equipment. Let's see, in January, they operated at 100%, which was 90,000 units. And they created an ending inventory of 8,000 units. In February, the company produced 82,000 units, but sold 90,000 units. And they sold it at $100 a piece. Okay, so for this first one, we're just going to do the absorption costing income statement, which is what we've been doing all along. So if we want to do our sales, so we sold 90,000 units at $100 a piece. So we have $9 million in sales. Now we figure out our cost of goods sold. And so our cost of goods sold consisted of what we sold out of our beginning inventory plus what we manufactured during the year or during the month. So we sold 8,000 of the units out of beginning inventory, and that had a cost of 60. So beginning inventory was 8,000 at a cost of 60. And then we also sold everything we manufactured, which was 82,000. Whoops. And that had a cost of $62 per unit. And we also had both fixed and variable selling and administrative cost of 1.674. So that is given. So under normal accounting, absorption costing, we have income from operations of 1.762 million. Okay, so let's jump in and do it for the variable costing method. And so for sales, that's going to be the exact same. There's no difference there. So we sold 90,000 units at $100 a piece. So we've got 9 million. And then we want to plug in our variable cost of goods sold. So we sold 90,000 units, but the variable cost, we just want the variable cost, not the fixed. So the variable portion is going to be $50. Oops, push that over here. And so now, instead of calculating gross profit, we're actually going to calculate our contribution margin, which is just sales minus variable cost. So now, instead of putting SG&A down here, we're going to move it up so we can get our contribution margin. And so that is given right here at 1.350. So now we have a contribution margin of 3.15 million. And so then now we plug in the fixed manufacturing cost. And so that's going to be the fixed manufacturing cost that we incurred during that period. So what we actually spent that period. And so that is given to us right here. So during February, not our beginning inventory, of 984,000. And then our fixed SG&A, which is 324. And so now, using the variable cost method, we have income from operations at 1.842, a difference of $80,000. And so the difference between that and the difference between these two methods is, in our absorption costing, we're assigning all of the costs that are related to the product sold. So that included our beginning and what was produced during the year. With our variable costing, the difference is we're taking our fixed cost incurred during the period. So that $80,000 difference is the $80,000 of fixed goods from our beginning inventory. And so the difference between absorption and variable costing is going to be a temporary difference, because what happened was, if we were going to prepare this variable costing for January instead of February, this $80,000 would have been expensed in January. So there's not going to be a permanent difference in these numbers, but it's going to be a timing difference of those fixed manufacturing costs. Where absorption costing, it's going to be, hey, we're going to expense them when we sell the goods that they're related to. But with variable costing, we're going to expense those fixed manufacturing costs as soon as we actually spend the money. So really not too bad at all. So.